In this video, I'm going to explain the basics of the multi-year guaranteed annuity. That is also known as a MYGA. MYGAs are very popular lately because of the sustained low interest rate environment that we're in currently. A MYGA offers a safe long-term investment, and it has a higher rate of return than many of the other options that people have available to them right now. It's also a guaranteed interest rate return. So in this video, I'm going to explain the basics of how a multi-year guarantee annuity works. We're going to use it in an example with some actual numbers and some actual interest rates as of current June 14th, 2016 interest rates. We're going to go over some of the pros and cons of buying a MYGA. Obviously, there's no such thing as something that's too good to be true, so you need to know some of the downside that can happen by buying one of these, but there are definitely some advantages as well. We're going to go over who should buy a MYGA, or at least consider it, and how you would go about positioning your money into a multi-year guaranteed annuity. So we'll try to keep the video pretty brief, but those are the basics that we're going to cover. So a multi-year guaranteed annuity is defined as a type of fixed annuity that has a fixed interest rate for a set period of time. So I'm going to repeat that again. The first part is it's a fixed annuity, and the second part was that it's in that annuity the money would grow at a fixed interest rate, a guaranteed fixed interest rate for a set period of time. What's important to know about annuities is, in general, there's two different kinds. There's annuities that you would use to generate income. That means an example would be you put $100,000 into an annuity, and then you start withdrawing $2,000 a month for the rest of your life or for a set period of time. That would be an income annuity. Those are very popular, used for retirement, but it's not something that is really at all what we're going to talk about today. The other type of annuity is used for accumulation. That means that you put money in and then it grows so that there's a larger amount of money to use later. Whether it's 3 years, 5 years, 7 years later, some point in the future there will be more money. That's an example of using an annuity for accumulation. There are several types of annuities that can be used for accumulation, and we're not going to get into all of them today, but the main three would be using a variable annuity, which would be something where you position money into the annuity. It goes up and down with the stock market. You have the highest potential for gains, but you also have risk involved, so you can lose money in that type of an annuity. The other type of annuity that's popular for accumulation would be an indexed annuity. That one will have some level of increasing in accumulation when the stock market goes up, but it also has zero downside risk. With that annuity, you are protected on the downside, so you won't lose any money, but you're going to be slightly limited on the upside because you won't participate in all of the stock market gains. It's usually capped out at a certain level, like 3 or 4% currently. The third type of annuity for accumulation is really the topic of today's video, and that is the MYGA, the multi-year guaranteed annuity. This one is going to be the simplest to explain, and it's going to be the easiest to understand right off the bat. With this one, you basically earn a set interest rate for a guaranteed period of time. That's what our definition said earlier. So in order to further explain how the MYGA works, it would probably be useful to use an example. Before I get into the example of how a MYGA would work, we need to make sure to make our lawyers happy and bring up this disclaimer. The rates that I'm using and the figures that I'm using in this example are only valid as of June 14th, 2016. So here's the example. Today's interest rate on the most competitive MYGA that we have on our platform is a 3.15% guaranteed interest rate, and that is guaranteed 5 years. So how would your money grow if you invested in this? For this example, let's just use a good round number. We'll say you took $100,000, and you positioned it into this multi-year guaranteed annuity. What would happen is over the course of 5 years, you would earn 3.15% compounding interest, and at the end of the 5 years, you'd have a total of $116,774 in that account. Now that assumes that you're not withdrawing any interest in a year, so you're getting true compounding interest. And it also assumes that you follow the rules. That means that you leave your money in there for the entire 5 years. As long as you do that, you'll achieve that $16,774 gain, and then you can roll it into a different investment or leave it in that annuity or withdraw it. If you're over the age of 59 and a half, you can withdraw the money. If you're under age 59 and a half, you're going to want to keep that within a tax-deferred asset, but we're going to get that into that in a second when we go over the pros and cons. But that sounds pretty great, right? You put in $100,000, you wait 5 years, you got $116,774. Well, not so fast. It's important to pay attention to all the rules in the contract. So one of the first rules is you follow the 5-year commitment. If you decide after year 2 or after year 3 or 4 that you want all your money back, you will not just get whatever the gains were up to that point and walk away. What happens is they will apply a surrender charge to your accumulation value, and they'll also apply a market value adjustment, which is kind of an interest rate adjustment if interest rates have changed. We'll get into that a little more later, but it's important to pay attention to the rules in the contract. So you're in that thing for 5 years, you got to stick with the 5 years. So those rules really bring to mind what we should bring up next is the pros and cons of a MYGA. There are several very advantageous attributes of MYGAs, but there are also some downsides. So let's start with the downsides so that we can make sure that if one of those really turns you off, you can, go to a different video and know that MYGAs aren't for you. But we'll go over what those are now. We already went over that there's a time commitment. You've got to be comfortable with the time commitment. There's going to be surrender charges as well as something called a market value adjustment if you break your end of the bargain and you try to access your money or you ask for your money back before the time commitment is up. The surrender charge is usually on a set schedule. They'll penalize you. Sometimes it's as high as 9% or 5%. Doesn't matter, but what they'll do is they'll look at your accumulated value and then they'll reduce it by whatever the percentage is for that year. Like if you're in the first year of the contract, it would be a 9% charge. If you're in your 4th year, it might be a 5% charge. But pay attention to that. The other part that could be a penalty is the market value adjustment. So if you request your money back prior to the time commitment, they're going to apply a very complex equation to the accumulation value. It's based on how interest rates have changed since you took out the contract, and they're going to adjust your amount either up or down there too. So that can be a penalty. Also, these are not FDIC insured. So when you buy an annuity, you should be comfortable with the insurance company that you're buying it from. Make sure you're going with something that's AM Best, has a rating on. Do a little bit of due diligence to make sure you're not buying from a very small company. If there's a rate that's too good to be true, it's probably either too good to be true or it could be from a very, very small company. We never recommend those. It's also important to know all the rules in the contract. So talk to your insurance producer. Make sure that that person is well aware of all the rules in the contract. You want to buy these from a experienced, specialized insurance producer that understands the annuity at least as much and probably more than you understand it. But make sure you understand all the rules as well. So an example of the rules would be, how much access do you have to your money during the time commitment period? So some of these might offer you no access to your money. Some of them would offer interest-only withdrawals, and some of them offer 10% free withdrawals. It's different for all the different annuities, but make sure you know the rules and you're comfortable with them. Then the last thing is these have, since they're an annuity, they're in a tax-deferred investment vehicle that is earmarked for retirement. That means this money should only be accessed after you turn age 59 and a half. If you are a 58-year-old, that really doesn't matter, because you're 58, you buy a 5-year annuity, by the time the 5 years is up, you're over the age of 59 and a half. Therefore, this rule doesn't really matter that much. If you're a 35-year-old, you don't want to tie up your money in this thing if it's money that you might want to use as a down payment on a house or something. So be comfortable with tying up this money until you're at least age 59 and a half. As far as the pros of MYGAs, there are several very advantageous things. First of all, they're safe. You're not going to be surprised that your money lost its value because the stock market went down or because interest rates went down. You have a guarantee from an insurance company that you're going to earn this return. What's also nice is these have better interest rates than most of the other mainstream long-term investments that are out there. For instance, the current rate on a CD at the bank, this is the highest rate I could find on bankrate.com, was 2%. In a savings account, the highest rate that I found that savings accounts are paying right now, and this is actually extremely high, the highest one is 1%. I mean, that's a money market account, not a savings account. But either way, with an annuity, you can achieve a slightly higher interest rate, which is obviously a good thing. The nice thing about these is that they're backed by these very large insurance companies that are highly regulated and have balanced portfolios that oftentimes they have A+ ratings, A ratings. These are big companies. Another thing that's nice is these offer tax deferral. The money that goes into a MYGA will grow on a tax-deferred basis. It is not taxed each year. If you buy a CD with non-qualified funds, then you'll be taxed each year on the gains that you experience within the CD. One of the other advantages to these is that they offer annuitization. This is not something that's often used, and it's not the typical reason why you would buy one of these, but it's a nice feature to have for some people. You can turn this into, if you decide you need access to the money but you don't need it in a lump sum, you can turn this into a income stream that would pay out for life or for over a set period of time or something like that. Oftentimes your beneficiaries could access it that way as well. So let's say that you understand the pros and cons of the MYGAs, and after wrapping your head around the concept, you think, okay, this might be for me. Let's make sure that you understand who should consider buying a MYGA. First of all, I cannot repeat this enough, you need to be comfortable with the time commitment. If you're okay with tying your money up for 5 years, that is step one. Secondly, you must understand the rules within the contract. If you feel confident that you've been explained how the MYGA works and you're okay with the rules, like even if it's a MYGA that they don't allow you to do your interest withdrawals each year, that might be fine for you. Maybe you're just looking for an investment for 5 years, but make sure you know the rules. And you're comfortable that your insurance producer understands the rules as well. Lastly, you have to be comfortable with the age 59 and a half time commitment. If you're under the age of 55, make sure you pay attention to when you intend to use the money within a MYGA. For instance, if you're 35 years old and you have a little bit of money in the bank, as soon as you buy a MYGA, that money is no longer going to be something that you're going to use for a down payment on a house. That's money that you're going to keep investing in tax-deferred or at least retirement earmarked accounts until age 59 and a half. Otherwise, you're going to get a penalty. So how do you buy a MYGA? If you decide this is what you want, you need to work with a licensed insurance producer. Since these products are sold by insurance companies, they are technically considered as insurance policies. You need to buy from someone who is licensed in your state to sell a multi-year guaranteed annuity. I would also recommend that you work with somebody who specializes in this type of annuity or in annuities in general, because they're a little bit complicated, and just because somebody has an insurance license doesn't mean that they understand the ins and outs of different types of annuities. So working with a specialist is probably recommended. I would also recommend that you shop around a little bit. Just because someone recommends that you buy a MYGA doesn't mean that they have the most competitive one. There are several different insurance companies out there. They compete against each other. They offer different rates. So shop around, and you should choose the MYGA that has the right rules for you and the right interest rate for you. If you want to review current interest rates, you can go to montanalifegroup.com, and we always update the current interest rates there. If you have any questions, we have a chat feature on the website. You can just chat us during business hours, and we'll help you out with whatever you're looking for. And that gives me an opportunity to toot our own horns. We are an independent agency. Therefore, we don't have a bias towards any particular insurance company. There are some insurance producers out there that have to work with a specific insurance company. We work with over 100. So it's our goal to always offer the most competitive rates and the best stuff out there, basically. So that's it for this video. We covered the basics of MYGAs. We did not go into them nearly as much detail as I'm sure some people would like, but we covered the 30,000-foot view as well as some of the pros and cons and used some examples. If you want to learn more, go to montanalifegroup.com. We've got a chat feature on there, or you can give us a call or send us an email, and we'd love to hear from you. Thanks so much.